Retail on pace for its best day since September. Small caps, a new high. Yes, I know they're still below their high, but still a new high, a 52-week high. Healthcare up 11% in the quarter, best quarter since 18. Financials a 10-year high. Staples record close. I mean, the list goes on and on. Josh mentioned Alphabet and Apple as well.
Can we talk about healthcare breaking out today? Can we talk about energy, which has big 13F filings, big hedge funds, value investors plowing into energy stocks in the third quarter, probably continues. These are the two worst performing sectors of the year. All of a sudden, catching a bid, seeing some new 52-week highs and some pretty key names. These are stocks that all year have been completely ignored. Getting traction in sectors like this that really have nothing to do, the healthcare trade has nothing to do with the trade war whatsoever. Seeing strength come into these stocks, it's not a vote of confidence that China and Trump are going to sign a deal. It has nothing to do with it. These are stocks with secular growth. They've been left behind, and now they're rocking and rolling. I think it's important to look at that breadth and to understand this is not what market tops look like.
You're not seeing money that is coming out of other asset classes. You're not seeing investment grade or high yield down. You're seeing a little bit of a rotation in the equity names as it relates to the bond proxies. That bond proxy trade is not as hot right now. Yep. Money is leaving there. It's going into financials. To Josh's point, it's going into healthcare. But again, I think you have to continue to focus on the U.S. consumer and companies that are selling to the U.S. consumer or retaining pricing power in relation to the consumer. Name I bought today is Capital One. That's a consumer finance name. It combines the strength of the consumer, steepening of the yield curve, more of a focus on credit cards, which is less risky than the mortgage lending, and it's got a fortress balance sheet in the mid-cap space with $80 billion of liquid securities, a market cap of $50 billion. It's a great name in the financial.
I think just one point here that I think is very critical looking into next year is the extent that the market, yes, it's great that we have this breadth today, that we have this great job number, but the one thing that has not corroborated the multiple expansion of the market has been earnings. So I think what is very critical at this point is there's a bottoming process of negative earnings revision for S&P earnings going into next year. I mean, some segments of the market, industrials, basic materials, energy, all expect north of 10% earnings growth next year, and that seems a little bit of a high hurdle. So I think there needs to be some calibration on that earnings number next year and some stabilization in that for this multiple expansion that's happened in the market to be sustainable.
That's a great point, and where I wanted to have the conversation anyway. What drove the market this far, multiple expansion, and whether earnings growth in, what you still have the trade issue out there. I'm not saying it's not having any impact on the economy. It clearly is having some impact. Can you get enough earnings growth to carry the market higher next year?
I think it's directional.
And how much do you need? 5% earnings growth, that enough?
Well, I think markets are always directional. They don't focus on a single point. They focus on where's the next point. It's like in earnings. Company comes out and misses. It's not because that misses, because they lowered their guidance going forward. Same thing with earnings. So
hang on real quick. Did you just, when I asked that question, did you say no?
Yeah, long-term earnings.
Because look at where we were able to get to, basically at record highs with negative earnings growth.
With negative earnings growth, but on the heels of a year where the comps were double digits and 3 times regular averages. So average earnings growth on the S&P is about 6.25%, 6.5%. Right now, I think broadly for the index, it's estimated to be 8% next year. That'll probably come down a little bit as we move closer and closer. I think anything at average or slightly above is good. The issue here is that this year, companies were able to underpromise and overdeliver. Next year, they can't do that as much. And we don't have that tailwind from the Fed. We don't have as much of a tailwind from trade. It's just kind of baked in that we have a deal. So the market is going to have to look at fundamentals. We need earnings to stay
We had earnings growth of 23% in calendar 2018 and an S&P 500 that finished the year down 4.8%. There is absolutely zero linear relationship between the amount of earnings growth within one calendar year and what the stock market does. Doesn't exist. You could look back to 1926. There's no such thing. The key is last year you were lapping one of the biggest tax reform packages in the history of the country. Of course, throughout the last year, 2019, it's been harder to grow. You're growing against the toughest comps you've ever seen. Companies had their corporate rates slashed to a degree that we've never seen. So people that look at the earnings growth, quote unquote, disappointment this year, It's all relative. It's not an absolute number. It's versus last year. You didn't have a second tax stimulus this year. Let it go. Now I like the setup. Now everyone's saying, oh, it's all multiple expansion. There's no earnings. Well, you know what? This is an easier year to lap. So talk to me next year, and let's see if we're still talking about an earnings growth.